Welcome to the Ontario Mortgage and Real Estate Insights Podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamoan, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions.
This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their home ownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode. Today, we're diving into the latest insights from Scotiabank Economics, which warns that inflation remains too persistent for the Bank of Canada to continue cutting rates. According to February's Consumer Price Index report, core price pressures have exceeded expectations, raising doubts about further easing. Steve, what are the numbers telling us?
Well, Janine, Statistics Canada reported a 1.1% month-over-month jump in inflation, with the Bank of Canada's preferred measures, the trimmed mean and weighted median consumer price index, rising at an annualized 2.9%, up from 2.7% in January. Some of this increase was due to the temporary goods and services tax holiday, but Scotiabank notes that broader inflationary pressures remain.
That's interesting, Steve. Scotiabank economist Derek Holt mentioned that core inflation hasn't shown a convincing pattern of disinflation despite a small amount of slack in the economy. He suggests this should merit the Bank of Canada ending cuts for some time. What are your thoughts?
Derek Holt points out that inflation is simply too hot and has been since last May. He argues that the long-standing trend indicates the bank's work isn't done. With inflation still running above target and showing little sign of a sustained downward trend, Scotiabank suggests the Bank of Canada should reconsider its policy stance. The upcoming March Consumer Price Index data will be crucial in determining whether February's inflation surge was an anomaly or part of a deeper trend.
It sounds like there's a lot at stake here. Market expectations currently point to a slim chance of a 25 basis points cut in April, but even that might be premature. Scotiabank's message seems clear. Further rate cuts could reignite inflation rather than guide the economy to a smooth landing. This could have significant implications for homeowners and potential buyers, right?
Absolutely, Janine. If the Bank of Canada keeps rates steady or even considers raising them, it could impact mortgage rates and affordability for many Canadians. It's a delicate balancing act, and the next few months will be telling.
Let's shift our focus to the latest report from the Canada Mortgage and Housing Corporation, or CMHC, which highlights a notable decrease in housing starts across the country for February 2025.
That's right, Janine. While the 6-month trend line for housing starts actually showed a slight increase, the monthly seasonally adjusted annual rate, or SAAR, of housing starts took a downturn. It dropped 4% from January, moving from 239,322 units to 229,030 units in February.
It seems like there's a bit of a mixed message here, Steve. On one hand, the trend line is up, suggesting some underlying strength in the market, but the monthly figures tell a different story, don't they?
Exactly, Janine. The trend measure, which is a 6-month moving average, reached 239,382 units in February. However, actual housing starts in urban centers with populations over 10,000 experienced a significant decline. They fell by 17% compared to February 2024, with only 14,459 units recorded this year.
That's quite a drop, especially when you consider the impact on communities and potential home buyers. It's interesting to see how different cities are faring in this environment. Montreal, for instance, actually saw a 6% increase in housing starts compared to last year, driven by both multi-unit and single-detached homes.
Indeed, but the picture isn't as rosy for other major cities. Vancouver experienced a 48% decrease, and Toronto saw an even steeper decline of 68% in housing starts compared to February of 2024. Both cities were affected by drops in multi-unit and single-detached starts.
These figures highlight the varied challenges across regions. For potential buyers, this could mean fewer options and possibly increased competition for available homes. It's a reminder of how nuanced the real estate market can be.
Absolutely. It's crucial for those in the market to stay informed about these trends, as they can significantly impact affordability and availability. The next few months will be critical in understanding whether this downward trend will continue or if we'll see a rebound in housing starts. Let's dive into the latest data on the Canadian housing market, Janine. We're seeing that house prices have surged, and it's creating quite a challenge for potential buyers, especially in major cities like Vancouver and Toronto.
Absolutely, Steve. The numbers are quite staggering. In cities like Vancouver, the average home price has hit $1,171,500, but the median family income is only $133,947. That's an income shortfall of over $121,000. It's a tough situation for families trying to enter the housing market.
It is, Janine. Toronto is not far behind, with an average home price of $1,061,900. To afford that, a household would need to earn $232,000, yet the median income is just $136,535. That's a gap of $95,465. These figures make it clear why so many people are finding homeownership out of reach.
What's interesting, though, is that cities like Calgary and Edmonton are presenting a different picture. In Calgary, the median household income is $147,643, which is actually above the required income to purchase an average home there. Edmonton offers an even larger surplus with a median household income well above what is needed to buy a home.
It shows how regional differences can impact affordability. The contrast between these cities highlights the challenges and opportunities within Canada's housing market. In places like Edmonton and Calgary, there's a bit more breathing room for potential buyers.
And while high interest rates have reduced demand, mortgage costs remain a significant burden. Financial expert Leon Turkin notes that mortgage payments have become more expensive even as demand slows. It's a reminder of how complex the housing market can be.
Right. And on a national level, the average home price is now $676,640, which requires an annual income of $150,500. With a median income of $124,672, the typical Canadian household is still falling short. It's a national issue, not just confined to the major urban centers.
It's also worth mentioning that condos, while more affordable than detached homes, still pose challenges in high-cost cities. In Vancouver, for example, the average condo costs $768,200, which requires an income significantly higher than what the average household earns.
And with these rising prices, we're seeing a trend of Canadians relocating to more affordable regions. Alberta, particularly Calgary, has seen an increase in demand due to its lower housing costs.
It's a dynamic situation, Steve. As home prices rise, some buyers are getting creative with their strategies, like co-ownership or seeking properties with rental income potential. It's a testament to the resilience and adaptability of Canadians facing these challenges. It's an interesting time for home buyers, Steve, with fixed and variable mortgage rates nearly at par. Buyers are facing the dilemma of choosing between the stability of fixed rates and the potential cost savings of variable rates.
That's right, Janine. Fixed mortgage rates have come down significantly due to falling bond yields, with the lowest 5-year fixed rate sitting at 3.89%. This is quite a drop from the 15-year peak of 5.49%. Meanwhile, the lowest 5-year variable rate is at 3.95%, thanks to a series of interest rate cuts by the Bank of Canada.
It's a rare situation where the spread between these two types is just 6 basis points. Historically, variable rates have been lower than fixed rates, which is why many have considered them more economical over time. But in today's uncertain economy, it's not just about the numbers. For some, the peace of mind that fixed rates offer could be worth the slight premium.
Absolutely, Janine. While some buyers may be tempted to choose variable rates, hoping for further cuts, it's important to remember that future rate reductions aren't guaranteed. The recent inflation figures, which came in higher than expected, might cause the Bank of Canada to pause its rate-cutting plans?
Yes, and BOCE Governor Tiff Macklem has emphasized that monetary policy can't fully counteract the effects of a trade war. So, while there's a chance rates could go lower, there's also the risk they might rise if inflation pressures increase further. It's a tricky decision for buyers.
That's why it's crucial for buyers to assess their risk tolerance. Those who believe the Bank of Canada will continue cutting might benefit from choosing a variable rate. However, they should also be prepared for potential rate hikes and the costs associated with breaking a variable mortgage.
And with fixed rates now below 4%, there's a strong incentive to lock in those rates for peace of mind. It really comes down to each buyer's financial situation and how comfortable they are with potential fluctuations in their mortgage payments.
Exactly, Janine. This decision is highly personal and depends on individual circumstances. Buyers should carefully consider their long-term plans and financial stability when choosing between fixed and variable rates in this unique market environment. Montfort Capital Corporation is moving forward with the sale of its mortgage lending business after receiving an exemption order from the Ontario Securities Commission. This regulatory approval, first announced in late 2024, marks an important step in the transaction process. Janine, what does this mean for Montfort and the market?
Well, Steve, the sale involves several key components of Montfort's operations, including Brightpath Capital Corporation, Brightpath Servicing Corporation, and Brightpath II Servicing Corporation. These make up the core of Montfort's mortgage lending activities. The buyer, Brightpath Holdings Corporation, is controlled by Blake Albright, who has a history with Montfort as a former director and senior officer. This connection might ensure a smooth transition.
The purchase price is quite interesting, Janine. It includes $13 million in intercompany debt owed by Montfort to Brightpath, as well as the value of 17.5 million Montfort common shares and 8 million 8% Class A preferred shares. These are calculated at 95% of the market price at closing. That's a significant financial maneuver.
Absolutely, Steve. And as part of the deal, Brightpath Holdings will transfer 11.5 million Montfort shares and all preferred shares back to Montfort for cancellation. They're also assuming Montfort's outstanding intercompany debt and issuing a non-interest-bearing promissory note equal to the value of 6 million Montfort shares. It's a complex transaction with multiple layers.
The Ontario Securities Commission's exemption order is crucial here. It relieves Montfort from issuer bid requirements under National Instrument 62-104, which allows the transaction to proceed without additional regulatory conditions. This could streamline the process significantly. ACDA.
Yes, and Montfort has agreed not to finalize the sale for at least 5 business days following the exemption order's issuance. March 26 is the earliest possible closing date. It's a strategic move by Montfort as they shift their focus toward other lending segments based in Toronto. CEO Ken Thompson has emphasized this transition as part of their long-term strategy.
The agreement also includes a call right provision, giving Montfort the option to repurchase the 6 million shares at the original sale price. This is conditional on the transaction not creating a new control person under TSXV rules and the share price meeting or exceeding the agreed value. This kind of clause offers Montfort some flexibility in future decisions.
And if Montfort doesn't exercise this option within 3 years, Brightpath Holdings may sell the shares to a third party, with proceeds applied against the promissory note. Any remaining balance would be forgiven. This provides a clear plan for both parties involved, balancing risk and opportunity.
Montfort's board considered several alternatives before deciding that the sale terms were reasonable, even if the value of the shares declines before closing, or if Montfort is unable to recover amounts owed under the promissory note. They took into account current mortgage market conditions, including rising loan defaults and declining property values in certain areas.
It's a thoughtful decision, Steve. The TSX Venture Exchange granted conditional approval of the sale back in February, and shareholder approval isn't required unless the transaction results in a new control person. Montfort's strategic shift could have significant implications for their future growth and focus.
Our final topic today is the retirement of David Mandel, who has been a significant figure in the Ontario mortgage industry. As the co-founder and CEO of First Source Mortgage Corporation, David Mandel officially retired on March 1st, 2025, after 18 years of leadership and influence in the sector.
That's right, Steve. David Mandel was instrumental in growing First Source Mortgage Corporation from its inception to a major player in the industry. Under his leadership, the company's assets under management reached over 460 million Canadian dollars by the end of 2024, and they funded 291 commercial loans totaling over 1.4 billion Canadian dollars.
Those are impressive numbers, Janine. Mandel's tenure saw an annual average return to investors of 9.8% over 18 years, which is a testament to his strategic vision and ability to navigate the complexities of the mortgage market.
Absolutely, Steve. David Mandel expressed his pride in what First Source has achieved and emphasized the competent team behind its success. He believes it's the right time to hand over the reins to the next generation of leadership, which is always a mark of a thoughtful leader.
Yes, and the transition plan seems well-structured. Leonard Zadner, who joined the company in 2018, has been prepared to take on expanded responsibilities as president. This ensures continuity and stability for First Source moving forward.
It's great to see a planned succession strategy, Steve. Leonard Zadner has expressed gratitude for David Mandel's vision and dedication, and he's eager to maintain the company's trajectory of success. It's always encouraging to see leadership transitions that are smooth and well thought out.
Indeed, Janine. As David Mandel remains on the board of directors, his guidance will still be valuable during this transition. First Source's focus on commercial and development mortgages in Ontario has positioned it as a reliable choice for financing, and this leadership change is unlikely to disrupt their momentum.
It's a testament to the company's strong foundation, Steve. With a team of experienced originators, underwriters, and administrators, First Source is well equipped to continue serving the Ontario market effectively.
As we wrap up, it's clear that David Mandel's retirement marks the end of an era, but also the beginning of a new chapter for First Source Mortgage Corporation. It's an exciting time for the company and its stakeholders. Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder, Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time and stay informed with the latest industry insights.